Hi, Carly. Welcome back.
Hey, Dale, it's good to be here. Thank you.
Great to have you back, Carly. So, I know that you've been negative the dollar for quite some time.
I
I
have.
don't believe that ever changed. I think you're looking for 97, 98.
Uh, yeah, so I've revised it just a little bit. You want me to share my screen and show
Sure.
the, okay, let
How
me
many
do that.
people remember your calls from 3.5 months ago?
Probably none.
I
That's
do.
how it works. People only remember the bad ones. That's how it generally
Oh,
works.
see, we all experience that, don't we? All right.
Right.
Anyway, so take that, haters. Carly's been negative the dollar from the highs. I don't think she ever turned. And you
I
have a
did not.
99 number up there.
Yeah, so things, I mean, the thing about this stuff is trend lines adjust with time. And
Yeah,
so
exactly.
so
Yeah.
we're looking now, trend line comes in about 99, and that's the way that my chart sees it is this is basically the I don't know if you can see the end of this chart. I'm going to scroll over a little bit. But you can see these trend lines date back to like 2017, 2018. So these have been
Wow.
going for a while.
They're like
Uh,
fan
this,
lines
they
running a
are.
trend, right?
Yeah, exactly. And this is like a weekly chart, and so we're coming up against 99 as like a big pivot area. It's kind of the line between bull and bear market. We had Russia not invaded Ukraine. There's a pretty good chance we never would have broken up above and saw this crazy rally and all that kind of
Interesting.
stuff.
Yeah.
Um, so the way I'm seeing it is if we break below 199, we're kind of basically going into normalization mode and getting the dollar to a more comfortable level. I think 99 might produce a little bit of a bounce. Your previous host was mentioning something along those lines, and I think that's probably a right take. But I think you can see we're in like this little wedge pattern. The largest bounce I could imagine ever happening is 103, 104, somewhere in there. That would test this trend line. And then I think we go down. Eventually, I think we're working our way to like the mid 90s. I think we'll be seeing that at some point. I mean, it takes time for these things to go, but we're probably talking weeks or months, not days. But I think that's where we're going is mid 90s. And
Okay.
if the Fed is forced to cut rates, which obviously jury's still out at some point, if the Fed starts cutting rates, then we're probably talking low 90s, like a complete round trip to where we started. So it's going to be interesting over the next couple of years. This
Okay.
chart actually, just as a side note, this chart will be on featured on Mad Money tonight. We're talking about treasuries, and I use this chart to kind of put together a bullish thesis in treasuries. A lower dollar is going to be very supportive for most assets, probably
Yes,
more so
you could be long
treasuries.
the world. Why the
Yeah,
treasuries,
exactly.
Carly? Why would it
Well,
be most bullish treasuries?
because unlike stocks, which have already benefited from a lot of the dollar sell-off, and stocks are kind of at lofty prices, bonds are
Yeah.
at probably, like, in other words, stocks are overpriced, but bonds are probably underpriced. So I think the
Okay.
dollar is going to help bonds more than stocks, just simply because of where they are in their cycle.
What's your proxy, TLT, that you're going to be using, or you're going to be
Um,
showing a
so
yield chart?
we're actually we're actually charting the 10-year note
Okay.
future, just because that's what we trade. We're a futures brokerage, so we kind of stick
Right.
with that.
Okay.
I will chart the TLT sometimes because it's also a good, like if I'm going really long term, I'll use that sometimes. But this is actually a really nice chart. This is a monthly chart of the 10-year note. And a lot of people tend to be negative on treasuries because of the what the Fed's doing and inflation and all these sorts of things. But those stories are probably at their tail end, not in their infancy like they were a year or two ago.
How about
So
positioning, Carly? You
mhm,
still have huge, large net short positions
we
by,
do.
yeah, okay.
Yes, I'll
All
show
right.
you that in just a second. So let me get through this chart, and I'm going to show you the COT chart, which is very telling. So you can see we've kind of chopped around here for several months. Some people consider that bearish, but the reality is, look, this is literally what treasuries do. They consolidate for a while and then they make their up move. So this is actually par for the course. The fact that they can't hold rallies is just probably treasuries basing, not anything other than that. And I think, we're probably not going back to the 1.5%. Well, actually, I think we could see 1.5%, believe it or not, on the 10-year yield. I don't think we're going back up to this crazy trend line up here where it took a lot of government stimulus and all kinds of manipulation. I don't think we're going to see that. We could easily see 10-year note at 2%, maybe even 1.5%. Somewhere in there is where we're targeting.
Okay.
Again, takes time. Probably not going to happen tomorrow, but this is what we're looking for. And in addition to just simply the bullish chart, why we think this might happen. Hopefully, can you see the COT chart here?
I see the T-note chart.
Okay, perfect. All right.
Oh,
So
yeah, underneath it, I see.
yeah, so right down here is the commitment of traders data. Commitment of traders is a report that the CFTC, Commodity Futures Trading Commission, puts out every week. It's a government report. It's disorganized, but you know what? The information is pretty good usually. So we use it a lot. We look at it every week and just kind of look. What we use it for is to identify markets that are maybe overcrowded trades or overheated. And what we've seen in the 10-year note is this, right? This green line is large speculators. So that's people that are speculating, not hedging. Or it's possible they're hedging, but they're not doing it officially, reporting that hedge. Anyway, it's mostly speculators. It's mostly people that are trading really big positions. And so these are considered to be the smart money. The thing about the smart money is they're usually smart until they're not. And when you start seeing these people get really long or really short, it's kind of a red flag. This is the largest net short position in the history of 10-year note futures. And we've been catching a lot of flack on this on social media. People are pointing out that the market.
Another good sign.
Yeah, exactly. People it's rufflings and feathers. People are pointing out that the markets are bigger. So of course the net short's going to be bigger. But the thing is, it's a net number. It's not a gross number. So they're taking shorts minus longs. Also, yeah, the market's bigger, but this is by far the largest net short position ever. The second largest was here, and that was about 680,000 net shorts. And right now we're at about 780,000 net shorts.
Is the blue line the commercials and the red retail small specs?
The blue line is small specs and the red line is commercials. Yeah.
They're
and
real
so
long.
They are. Yeah. And so at some point, and see, they were same in 2018 when we bottomed, there was a really big spread between those two types of traders. And you see that now.
Yeah.
And reversion to the mean tells us that's going to unwind itself. And when it does, we're probably looking at much higher 10-year note, maybe 124, 125, like the chart that we were just looking at suggests. So
okay. Real nice look. So you were talking about crowded trades. So you know what I'm thinking.
Probably.
What's the most crowded trade out there right now, besides bonds?
Well, besides bonds,
long equities.
I don't know if that's getting that crowded, but it's well, see, I'm only looking at futures, so it's a little bit different. But let's just take a look here. Whoops.
Maybe that's why it keeps going. It's not crowded.
Right. Well, the thing was,
not. I've seen things like greedometers at extreme greed and call indicators, but it still looks pretty good, huh?
Well, okay. So a few months ago, we went out on the various news outlets warning people that there was the largest net short position in the history of E-mini S&P futures. And people laughed at us. So we got hate mail, but the reality is that position has unwound itself. About half of it's been unwound. You can see that's what this little bump is right here. So speculators are actually still net short. It's not as extreme as it used to be. So it's not going to be the tailwind that it was over the last couple of months. But I don't think we're definitely not net long. Now, if we're talking about like mom and pop investors and that sort of thing, retail investors on the stock side, that could be a completely different picture. So I don't know. Unfortunately, we don't have this kind of information for stocks. So it's more of a guessing game, and we're looking at sentiment indicators. But I agree, the sentiments, people are starting to get a little too complacent. We've got our target in the S&P is about 45.50. Let me see if I can find that chart.
We're almost there.
Yep, we are not too far off.
Yeah, 45, 45.50. Okay. All right. So I know last time you were looking at gold. as well, and you liked it, and it grinded for a while lower.
Right.
All right, what are we looking at here?
Well, I
Oh,
was trying to
corn.
find a good S&P chart, but I
There's a
didn't.
good one.
Yeah, this one's pretty good.
I
I
like
did
that
have
one.
a better one, but this is good. This is the daily chart. And so this is basically what we're looking at. We've been looking for the short squeeze to play out, and we think that it has mostly played out. So with that in mind, we've got trend line coming in here right around 45.50, and seasonality is still bullish for the next handful of weeks. So you want to be careful. Sometimes with summer markets, the volume's light, it's thin, and it just grinds higher because the only people participating in the markets are active traders who are usually net short. And so it ends up being a short squeeze environment. But that said, we turned bearish at 45.50 and would like to see what happens. I'd say pretty good shot at a nice correction. I'm not bearish. I don't think the world's ending, but we could easily see 4,300,
200.
4,200. Yeah.
Yeah, that was a breakout. Yeah.
Yep.
Okay, and energy wise or precious metal wise?
Okay, so let's take a look at gold real quick. I'm still bullish gold, but the thing about this market is it spends almost all of its time trading sideways, and then it makes its move all at once. And so it's really, really tough for active traders. It's just a weird market. This is what I've got in gold. And to be honest, I thought we were going to sell off a little more. I was looking for like the mid to high 1800s as a place to really get aggressively bullish gold, and it just didn't happen. So
Yeah.
we'll see how it goes. Honestly, this kind of stuff, things change fast. It's not impossible that we still go down and test that. So if you're flat and you're waiting for a place to get in, you want to be conservative, maybe consider something in that ballpark, 1860, 1875, somewhere in there as a place to put on your radar. Ultimately, I think
Where's that red moving average coming in underneath the trend line? Is that a moving average?
This one here.
No, above it. No, it
This orange
must
one.
be a moving average, right?
This orange, yeah, this one right here. Okay,
yeah.
that's the 200-week moving average. So yes, and
That's
it
where
would
I'm a
have.
buyer.
That would be a great place to be a buyer. I would
Yeah.
love to see that. I was hoping for that. Didn't happen. It might
Well,
happen.
maybe
You
we
never
have to
know.
rally to 2000, 1980 first, and then if you get your 99 low in the
Right.
dollar. So I'm putting your narrative together for you.
There you go. That's a good one. You're right. But
Okay.
generally speaking, just as a rule of thumb, anytime the market touches a 200-week moving average, never any guarantees in this game, but that's pretty good. That's pretty close. It very rarely will. I mean, the 200-week moving average is a place that if you're a value buyer trying to buy a dip, that's just a place that makes a lot of sense and it works out more than it doesn't.
Nat gas still a value, isn't it? And maybe it turned the corner.
It is. It seems like maybe this is nat gas. I'm constructive in nat gas, but we're probably going to at least retest this trend line. So we probably have this is right now we're trading about 260 on the front month. Could see 245, 250. And honestly, the way nat gas is, I wouldn't be super shocked to see 210 just to basically ruin a few lives before it does it.
So there are more widows that collect on
Exactly.
life insurance.
100%. That's what it does. So you have to be really, here I'd be a nibbler, here I'd be pretty aggressive. That's how I would look at it. But all in all, I think, yes, it's a long-term buy.
Okay. And I know you follow eggs, and
I do.
We have Grand El Nino out there. We had a pretty good rally in beans, and wheat's still putting in a higher low, but corn has been the dog.
Corn has been, yeah. So we got
trying it here.
We are just nibbles. I wouldn't. Here's the thing. This time of year, grain rallies can be magnificent because there are weather concerns and people panic, but they almost always fail. And so you want to be really, really careful. And this time of year, even with corn in the hole like it is, fundamentals are actually pretty supportive for corn, but sometimes that doesn't matter in the short run. I worry that if we close below 480, this is December corn, by the way, this is new crop corn. If we close below 480, there's just this big gap, and speculators are still net long even after the sell-off. So I worry
Wow.
that we get, like, if it continues to rain, rain makes grain and people just sell without even asking questions. That's how people have been
When I
trained.
was a young man, they used to buy rain breaks. In a bull market in
I
grains, you buy the rain.
You would think so. I don't know if it's the algos or what, but it
But that's
literally.
prehistoric times, Carly. That probably
Right.
doesn't work anymore
So
because
I,
no one's at the board
yeah,
of trade anyway.
that's true. Nobody's there, so they have to actually check the weather reports. Um, so what we're doing is just buying 550 calls. They're really cheap. You can get them for less than $1,000. I think last I looked was like 600-700 bucks, and it's just
Mhm.
that'll give you 100 and something days in the market with low risk, limited risk, and we can see what happens. I'd be willing to get more aggressive if we dropped to 450. 450 would be extremely cheap for corn. If it happens, it happens. I mean, you can see we're holding the trend line here. So there's probably a 65-75% chance it holds and rallies, but I wouldn't be willing to jump in with
Wouldn't it
anything
be
real
a
big
better
here.
shot buying a market making higher lows like beans or wheat on weakness rather than bottom
Um,
picking corn?
well, here's November soybeans. I don't have this.
Yeah.
Isn't the best chart. We actually have some trades on in beans. We're
Okay.
bearish beans,
Oh,
and mostly because of seasonals. So,
okay.
like,
1250 you're looking for
yeah,
maybe?
yeah. So I would say this on November. I would say anything around 14 is a place to be a bear. We're looking for, you're right, about 1250. Maybe if things get real crazy, 1150. But again, just simply because this time of year, it's really, I haven't seen very many people make money buying and holding grains this time of year. It's usually just a sell the rallies kind of thing. You might take some heat early on, but eventually it works out. And so that's how we're looking at it.
Okay. Anything, I think we've covered a lot of the board. My takeaways really pay attention to yields and notes. Um, Pay
Yes,
attention
for
to the
sure.
Dixie, maybe around 99.
Um,
And okay, here's some
I'll I'll
I
throw
pay a
this
lot
out
for
here.
steaks now. Go ahead.
I know it's insane. Cattle. I'm just going to throw this out here. Maybe nobody
Wow.
trades cattle whatsoever, but
I
this is a
can't
trade we
believe
put
these
out yesterday.
prices. You know,
It's
I was
a,
a runner on the
insane.
CME floor in the
Yeah,
mid 70s. I just cannot believe these prices.
it's wild. The demand just doesn't, price isn't deterring demand, but I think eventually it will. And the seasonal top in cattle is like late July. So I think anybody that's got upside exposure here is probably just pressing their luck at this point. We put on risk reversals yesterday. We recommended to sell 195 calls in December and then buy the 175 puts. I mean, for educational purposes, I'm offering this, not to tell you to go do that. It's not for everyone. This is mostly, if, like, we have a lot of cattle ranchers and this is a wonderful way for them to hedge their price risk because it's free
Oh,
insurance. Yeah.
yeah.
So they, like, the
Wow.
money we collect for the call pays for the put and they get free insurance.
Right.
And then that way they can just see what happens and they still get to make money from
If it
182,
goes
which
up.
is right. They get
Yeah.
another 10, 12 points out of it. But they have risk control in place. Anyway, cattle has only behaved this way one other time in history, and it was like 2014, 2015. And when it, in those years, had this miraculous rally, just like we're seeing now. And then once it rolled over and died, it literally died for a decade. Like we're just now getting back up to those prices that we were in 2014. So I have a feeling we're kind of repeating something like that, but it's hard to pick highs. You just never know how high is too high. Eventually it hits. And after the fact, it's easy to point out, but before the fact, you don't know. But I think chart wise, fundamental wise, and seasonal wise, everything's lining up for this to be a potential place for cattle to roll over.
Okay. Well, people that watch this video later, people that are watching it now, um, and I'm very, impressed with Carly's knowledge of not just being a technician, but her knowledge of the fundies and the way she follows commitment of traders reports and, her strategies of how she's tactical. So best way for people to follow you and stay in touch with your work, Carly, would be.
You can visit our website, decarleytrading.com. You can sign up for a free newsletter trial. There's a tab over here on the side that will allow you to do that. And you can kind of follow along and see some of the things we're doing. if you're on social media, which I suspect you are if you're here, we're on Twitter. The handle is at Carley Garner.
Okay, and really, how many commodity people or futures people know how to trade and also how to set up a hedge for producers using options? So that speaks for itself, Carley.
Thank
It's
you.
always great to, you know, get some real elite views from you.
I
Much
appreciate
respect.
it.
Much respect. I'm a fan.
Well, thanks, Dale. I appreciate it.
All right, Carley Garner, everybody. Check her out. I'm introducing her to you for what? How many times have we done this now, Carley?
I've lost count, but it's been several, so it's
Yeah.
been a good time. Yeah.
All right, let's keep it going and have a
Sure.
great summer trading season.
Thank you. You too.
I'll be in touch with you, Carley. Thank you.
Yep.
All right, so that's a wrap, everyone. And you can join the team in 17 minutes. Okay, you're welcome, Patrick, Jean-Francois. See you guys. You're welcome, Rick. Don't just count your pips, count your blessings. I know you probably get tired of hearing me say it, but force yourself. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.